Good afternoon, ladies and gentlemen. Today was the first trading day with Trump in office, and we closed around the highs of the session, overtaking the treacherous day over here. We shall no longer speak of December 18th. That closed way down here at 585. If you look at the SPY, we undercut this prior swing low, and we came ripping back to the upside near and around all-time highs. Did you miss it? Did you get locked out of this rally? We're going to go over some stocks to watch just in case if you did. We're going to map out some very important key levels just so you don't FOMO into what's currently going on right now. That's what we're going to talk about on today's Stock Market Brief show, which is brought to you by the subscribers and people that like and comment the show and my Patreon group. All the patrons there that pay $9 a month, or they did the annually where they get to save a big chunk there. They get access to all kinds of tools, and my partners, Interactive Brokers. Make sure to check them out. They have a whole host of resources. Let's get into today's show. All right, ladies and gentlemen, welcome back to the show. So S&P 500 starting the week rather strong today, above its weekly 5 EMA. You can see last week we had a big bearish reversal candle, how it started at about 5,775 there for the SPX, and we engulfed the prior week's body. Remember that we talk about when we get pretty extended from these weekly 5 EMAs, it's typical to get some sort of a snapback. That's what we call the rubber band effect. It gets very extended, you snap back and so forth, pop, 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 pop and drop all around town. The 11 sectors were basically up except for energy, and this makes sense because crude oil was down there as well. Industrials and real estate, healthcare, utilities led the way, which does feel a little bit more risk off in essence. And I guess if you look at the heat map, you'll notice that Apple and Microsoft finished down on the day. Tesla down a half a point, but this was down almost 4%, or if not a little bit more, and it recovered its entire day basically. So Apple was the laggard there. The 5, 10, 20 timer is starting to come back into alignment over here, where you had the 5 EMA stacking above the 10, which is stacking above the 20, which is a good indication, albeit that it is a little frothy here. It's not something that I would necessarily short, but maybe starting new positions right here, you might want to wait for some sort of consolidations, and we'll map out some of those key levels as we go into the more intraday timeframes. The markets seem to be working off some oversold divergences, where we had some oversold divergences over here on the RSI for the bullish percent NASDAQ composite bullish percent index, where we had low readings, but a higher reading there. And then the market's ripping higher from those points, and it still has some room to go to become somewhat overbought. The BPNYA, same thing. We had that bullish divergence. It's playing out to the upside. That's why it's so important to know when these things take place. The bullish percent index for the SPX, right? We had a bullish divergence right there. And boom, the market started ripping higher to and around all-time highs. We talked about the percent of stocks above the 20-day moving average and how they were getting very frothy to the downside on various different indices. So we had the S&P 500, the 600, which is small cap, mid cap, the 1500, the 100, which is the largest market cap names in the S&P 500, the Dow Jones, NASDAQ, and so forth through the list. And we talked about how if you zoom in on the S&P 500% of stocks above the 20-day moving average, you had a higher low reading over here. And that happened to play out for a bullish divergence like it did over here, where we saw a nice rally back. Now, are we going to get the same outcome? We don't know what the case is going to be, but I will note that now the percent of stocks above the 20-day moving average, now we're looking at 81%. So that reading changed dramatically, which is now moving into more of an extended reading, but extended, once again, can stay extended for a period of time. If you look at back month versus front month volatility, it's not giving us an extended reading to the upside by any means yet, but it is starting to cook. So if we start to get up a little bit higher, be just mindful into and around the 1.20, which tends to be an area where we can consolidate. Notice here the last times that we got there, price went sideways. And when we got there again, boom, price came back down. So it was just an overall period of consolidation that happens throughout history, throughout this pattern throughout this chart that we've shown in the past. We had a buy signal and a buy trigger take place on Bitcoin. So this is measuring and mapping the rate of change between Bitcoin and gold. I call it the Sailor to Shift tool. Looking at the 4-week rate of change. And anytime you see a red or green line, that's the official trigger. And sometimes you get signals with no trigger. So we officially got that where the price of Bitcoin did cross above the prior trading week. And that's roughly at about 106,000-ish, right around there. So we're basically flat since that took place. And then the last sell signal, sell trigger, we did see some weakness, but it started to recover. So we'll see here if Trump wants to say anything crypto related and if it helps out. But overall, it's bullish right now. Now I want to get into some of the signal charts, more specifically the zones indicator that I share in the Discord group. Sorry, the zones document that I share in the Discord group. It's based off of Joe Cat's bridge bands. And going back to January 13th, right? On Twitter, I posted, or sorry, on X, I posted this. On January 13th, I just said froth. For those that understand this, they know what I mean, but a lot of people might not know what this is. But simply put, you have the lower band, the higher band, and then the red line and or green line is the trend determining whether it's bearish or bullish. So S&P 500, what I was calling out here more specifically was that the dollar, right, was in a green trend, but it was reaching towards its upper band. And then more specifically was the 10-year yield, and it was reaching up to its upper band there too as well, basically stating froth. Now, if you understand how these work, typically from an intermarket standpoint, right, when you have the dollar frothy up here and the 10-year yield frothy up here, look what else is towards the bottom. Well, the SPY is towards the bottom, right? HYG is kind of back down there, obviously TLT too. And then this is because of the negative correlation typically that you have in these markets. And well, what happened, right? So January 13th was right here. It was this trading day after some sell side. All right. And we started getting, right, frothy readings. Okay, well, what happened? Well, now from January 13th to here, we saw a big, massive snapshot back up. Well, just recently I posted another tweet, and that happened to do with froth, but like in reverse. And this is the now updated daily zone document coming into some extended areas. So this was prior, right? This was prior, and this is now. And what do you notice? Well, now the 10-year yield is coming towards its end of the range, which still has room to go. And then the dollar is reaching down to its lower band there too as well. So if the dollar were to snap back, or the 10-year yield were to snap back, is that going to put pressure on the S&P 500? Is it going to put pressure on high yield and TLT there too as well, where they might neutralize a little bit and come back more towards the middle of these bands? And I think that that's a possibility as we're moving more towards this end of the trading month. So if I show you what this looks like, this is the dollar, these are the bands, you have the lower, right, you have the upper band, and you can see the dollar is pulling in here and trend is way down here. So we're still within a bullish trend. It doesn't mean it can't go lower, but just be mindful that the dollar is reaching down here. And this is even when Trump was mentioning tariffs again today, the dollar actually didn't rally really from that level. So that could be a positive sign to see the dollar weakened even further. But just be mindful that it is reaching down here. And the last time we reached down here was right here, and it rallied. The last time prior to that was right here, and then it rallied there too as well. And those are both the times that it happened within the bullish trend, which took place over here on October 7th-ish range of last year. Now, while the dollar is coming in, you can see that the Euro USD is obviously reaching up to its higher range there too as well, where its trend is still bearish as it stands, which makes sense because it's kind of obviously the flip of the dollar. And if you look at the 10-year yield, the 10-year yield's lower end band right now, which is just dynamic and it's going to change, but going into tomorrow, you're looking at about 4.5% on the 10-year yield, and it is still in a bullish trend. So if you think that the 10-year yield is going to rally, right, from these levels, a potential equity that you can look into is by Simplify. It's a Simplify product, Simplify ETF, a PFIX, and this would move with the 10-year yield to the upside if you were looking to trade that to the upside. Now, I want to look at some of the Mag 7 stocks and kind of see how those are positioned within their bands as well. And NVIDIA over here, NVIDIA still has some ways to go. Today, it actually went into a bullish trend, but it's kind of been flipping and flopping, so I'd consider this to be a little bit more neutral than anything. And its upper band is roughly at about 147, sorry, right now, and it is moving in the after-hour session based off of some AI news. Apple, you can see the top end of the band is coming significantly down, the lower end of the band significantly down, and we crossed down into a bearish trend at around 240, approximately 5 to 7 trading days ago, and it's reaching down to its lower band. And these are keep dropping, right? This is pretty dynamic, but just be mindful that we closed outside of the lower weekly expected move already, so chances are that we'll come back the probability suggests that we'll come back within that. But Apple has seen some significant sell side as it broke that trend and is coming into those lower bands. Microsoft, it is in a bearish trend as of right now, and the upper band has been coming in. And you can see there that it's kind of coming in confluence. So be wary of Microsoft as it stands. I will note that the lower band is starting to pick up here. The upper band is coming in. And when you get this compression, you typically can get some explosive moves, right? One of the basic principles of technical analysis is stocks move and assets move between expansion to contraction, back to expansion. So as these are joining together, we can see some explosive moves, whether that be to the upside or downside, I don't know. But right now it's currently, as it stands, in that bearish trend. Google has been a very positive looking chart, been going sideways after a strong move, but it is reaching up to its upper band here as the bands are rather compressed and still within that bullish trend. Earnings is right around the corner. Meta, this one is still rather tight. It is within a bullish trend. We came down to test that trend and we kind of doodled around it here, but we have about the lower bands coming into and around that lower trend. So anywhere down here would be a potential buy in Meta in and around that 600 range. And then you'd be playing it up to around 640. And if this keeps going up, maybe even 650. And we'll look at that chart a little bit later. Tesla, you can see also this one's been coming in significantly too. We closed flat on the day. The bands are coming in both bands. They're above the trend as it stands, and they're both kind of coming in. So it is compressing right now as we're heading more closer into the earnings. So the reason why I want to show you that, simply put, is because as the dollar has reached down to the lower range, as 10-year yield is near there, these do affect these mega cap 7 stocks. There is a negative correlation to them. For the most part, we've went through on prior videos. So a lot of these names, if they're going to be reaching right to the upper portions of their bands, you might want to pay attention if the market wants to rotate into weaker ones, potentially Apple, right? But that's pretty weak. But you have Microsoft coming into the upper band. You have, like I said, Google reaching up there too. And Meta still has some space. And then Tesla is kind of near it as it stands right now. So it's something to just be cautious of and look for periods of consolidation for further upside. This is, once again, this is not necessarily a market that I would be shorting, given the context of where we stand in the overall trends and in the market conditions. So let's look at market conditions. How does it look? Well, we have our call wall about 6,100, put wall at about 5,800. So traders are reaching out further, as you can see. That's a positive sign. If I pull up this chart, we've had a lot of chop. The last time we were at 6,100 was right before that December 18th sell-off. And you can see we came into 6,100, which happened to be a very important level at that time as well. And we're starting to rally up into and around these areas as we remain in positive gamma territory. When we're in positive gamma territory, that's where dealers buy the dip and they sell the rip. This is where volatility typically decreases. So that's a positive sign as we're seeing. But just be mindful that this rally has been somewhat of a lockout rally, meaning that we kind of rallied here, but then we gapped and kind of camped through the day. We gapped and camped. Then we gapped. It was choppy, but we did finish at the highs of the trading session there. The next thing that I look at for market conditions is the directions of the 5-day moving average, and it's pretty much check across the board. We have green lights, so that's positive, meaning the direction of the 5-day moving average and all these products, SPY, Q, IWM, they're all trading higher, right? So there's really nothing to be bearish about. It's surprising to me that the S&P 500 didn't try to rally even further than this, but it's nothing to really be bearish about. But I would say it does come with a little bit of caution when you try to execute larger positions at higher readings without waiting for consolidations in the market from an intraday perspective. And I'll show you this more on the expected moves charts here. So if I look at SPY, right, here's SPY on the 15-minute time frame. Above that rising 5-day moving average in purple, we're above the year-to-date anchored volume weighted average price. Both positives. We're above last year's closing price, another positive, okay? So these are positive things to see, but just note that the rally has been pretty aggressive to the upside, and I think that there's still upside, right? So where would the upside be? I think that the upside is right here to and around 609.25, 22. That is the upper monthly expected move. That is what's the price kind of, what the market priced in last month for this month's risk. For the weekly expected move, we have 606.40 to the upside, okay? And then 588 to the downside. That's for SPY. Now, we also have confluence with tomorrow's daily zone, which is daily implied move is 606.32 and 608.77. So if we're going to catch some momentum from today's high and we're going to follow through, I think that these are very possible levels to see, but just be mindful that if we reach up into these levels on this type of a lockout rally, be very cautious if you're like now executing heavy or you FOMO into these levels, because this is what the market price in for risk, and you've missed a large portion of it with no consolidation whatsoever. If you look at the Q's weekly implied move is at 531.67. 536.60. So you can see it's further away than the SPY is. And that's because, well, we need some of the bigger market cap names to perform that didn't perform. Like, for example, Microsoft and Apple, two of the larger market cap names. Surprisingly enough today, I should mention that NVIDIA took the top spot in the S&P 500 as the largest market cap name. Pretty impressive stuff there. So if we get some play from Apple and Microsoft, that could very well help us project further. But these would be the levels of risk that I'd be watching for if we get some follow through, and that'd be positive. So how am I trading this? So first and foremost, I was getting more exposure into the market when we started to see those divergences. That's why I went over it at the very beginning, right? We talked about these divergences when they were happening. I started looking for entries. I started getting some exposure into the market just to have. And then when we started flipping into positive gamma territory, when we started getting above the flip line, when the 5-day started to flatten out, we started to get here, I got to add a little bit more exposure in various names. And then it played out to the upside. So my personal, what I currently do here, if I didn't have that exposure, I would just be kind of locked out at this point, or I'd be looking at individual names that maybe have not seen or participated in the rally, but yet are still in bullish context, because there may be a possibility that we can see some of those names go. And that's what's going to bring me into the stocks to watch section. And we're going to go over a bunch of names from my tight list, something that I share every week. There's 3, 4, 5, 6, 7, 8, 9 stocks that I'll go over that haven't seen the upside move, but yet are still in tight consolidations. So when they break out, it could be a potential, opportunity. So for one thing I want to close on here on the expected move section is if the market wants to roll up into these areas, I'll probably reduce some of my exposure and then try to add back on a consolidation, because things are going good. But I know that if we get into these levels, we can kind of get tied up for a little bit. And so I'll probably reduce some additional exposure, because the beta of my portfolio right now is outweighing the S&P 500. For example, today the S&P 500 was up about 90 basis points, and my portfolio went up about 1.5 basis points, 1.3 to 1.5. So I would probably reduce it a bit to just come in line with the beta of the S&P 500 during a potential consolidation area. And if we keep continuing to rally and we locked out, I just get to participate in that upside with various names. Okay, so let's get into some of the stocks to watch. Okay, the first one is a pretty high beta name. This is NBIS, and this one has seen a lot of relative strength. It's above some key moving averages over here, the 20 and the 50. And you can see today we kind of were at the low, but then we closed at the highs. And as it kind of reached into this prior supply here, but over here, we've been kind of flagging out. So if it comes in a little bit and sets up through this level, I think from where we are right now, it's an easy shot to 40. And if we break through that, this could be a pretty strong mover. So just be very mindful for risk on these type of trades, because look at today's close, right? This close from this, that's a 4.3% move. So that means if that was 4.3%, just to this low is darn near 10%. So be mindful that if you put a stop under 35 or under today's low, you'd be risking about 10% there on that trade. So you really need to make sure you're paying attention to position sizing in. I'm not going to reiterate that, but that goes for all of these names, okay? WAY, so WAY, this one saw some strength today, up 1.65%, and it was one of its highest close. It did hit a new high, so that's positive, but you see this low, this higher low, and price is getting pretty tight here, and it's trying to move through this pocket of 38 in bullish context, so this would be a one on the radar for potential some follow-through. Meta was the stock that I said I'd come back to, and here you go. Meta's consolidating here, and it has 4 trading days of some pretty tight price action. So to come retest 630 and potentially go higher here, that makes sense, but have a stop under probably at around this 600 or maybe even the 50-day. Depends on where you want to kind of level your risk at. If anything, right? So this low right here, say 600, it's at about, we're just going to round to 620 because I don't have the exact number in front of me, but you'd have to make sure that you're okay with losing $20 per share, and you'd want to make sure your position sizing makes sense for that. PLYA, we've had 1, 2, 3, 4, 5 days of some pretty tight price action, and you can see price is getting really tight right at around this 1250. So potentially watch for a break there with a stop below the low on a breakout candle. Asan, This one's a little bit more sloppy, but we did have a nice earnings move and had some follow through. And since that point, it's kind of been just coming back into an inclining 50-day. And right now, we've had 4 trading days, pretty much right at around 20. So if you have a stop at the low of today's trading session and you potentially get some follow through, that might set it up for a move to 22 or potentially even higher. If you want to give it more room, maybe under the 50-day moving average, and you're playing this is your risk, and maybe up to here is your potential reward, or maybe even take some off at about 22.50 where we saw this prior resistance. But just be mindful that if it breaks down, just respect that, right? Respect that. You want to set it and forget the trade for the most part, and just update risk parameters as you see fit. TBCH also saw a strong move on volume in the last few trading sessions. We're just consolidating that. So maybe through 19, I'd like to see a couple more days of consolidation, but maybe through 19, you get a little bit more of a pop. Crowd, CRWD, right at about this 370. Today was an inside trading session. It's been basing out for some time. Very choppy and sloppy. But if this does break out, this might present itself an opportunity back into and around this prior high. So if we do get some follow through 370, you might have a stop down here at a 350 and or just under today's low, which is right at around the 20-day moving average and a little bit further away from the 50-day, but the 50-day is inclining. So that looks good as we tighten up there on that right side. P Core is another one that's been going sideways and hasn't seen the pop from this recent rally, but volume's been drying up. We had a little bit of an undercut over here and some pickup. So kind of through around this prior area of supply, which is right at around 80. And then you can have a stop maybe underneath this tight consolidation these 4 days. And if that does play out to the upside, you're talking a pretty good risk to reward. We're looking at maybe 2 to 1, maybe even better. I will note that today's candle was an inside candle. So on these type of moves, if you get a breakout of the high, sometimes people just put a stop under the low of that today's trading session, and then it tightens up the risk further for an expansionary move. But you also got to be a little bit more aggressive on taking partial profits or moving your stop, because if your position sizing is large, you don't want positive to kind of come back and whip really quick. But that's just one way of approaching an inside trading day. If you look at DocU, I do have a position in this one. We've had now, how many days? 1, 2, how many? 1, 2, 3, 4, 5, 6, 7, 8, 7, 8 trading days of very tight price action. We're still above a rising 50-day moving average. My stop's down here, and it's only it's just over a 2% position. I think it's a 3% position on DocU. The zones, the bands, they're getting very, very tight here. So I'd be expecting to see an explosive move in the very near future. Now that explosive move, I don't know if it's going to be a whipsaw, boom, boom, boom move, or if it's going to break out to the upside or to the downside. But what I do know is this: the current trend after earnings, right? It's consolidating back into a rising 50-day. 20-day is starting to flatten out over here as prices have been going sideways. So my bias would be to the upside, but I'm willing to get out if I'm wrong, obviously, right? So if that makes sense, that's kind of what I'm looking at for a potential move. I'd like to see it back over here to 100, 105, but it did have some supply right here at about 100. So I'd probably have to consider updating risk parameters right at around 100 if it were to even come into that level. That's all I got for you on today's episode, everybody. Hope it helps out, gives you insight into the current rally that we're seeing, but just giving you an idea of saying, hey, cautious as we approach some key levels after already a very strong rally. Hope that helps. See you later.